here we are. We're looking at Google and pre-market. That's another one. We have the 605 put that we're looking at with one of our MMTs, but he also owns a $600 call. And overnight, he got in down toward, the lower end of this 605. And we're currently trading 610 with a 608.33. That is a $2.00 ratio gap. That's what it means in our platform and the way we do business. And that's what the bid is. The ask is 71 pennies. Of course, it's higher. But however, the pre-market volume is only 86, not even 8,600 shares, 85.64. The thing about the option side is that when they mark these things down, here's that 595 was up 7.9. Here's the 600 call at 6.2 up yesterday. Whoa. And there's that 620 call that one of our MMTs own. So I'm going to be giving a limit order out on this. This is a 1217, and it is a 620 call. And it is, well, Bill, this is in yours, so I'm going to tell Brian Plain to put a limit order out to sell here at, let's say, 18.8. And that would give you a very nice gain on your contract on the 1217 620 call, sir. And that way you would have a profit objective. Write the number down, sir, and then update me. Here it is. We're live. That is a ratio gap there. Now, Tom, when it pulls back this contract, the 605, see, it's a $2 gap. So, of course, these are going to come down in value. You only have a single contract that you were using here with your profits in a $600 call. So, you can't lose money either way. However, where do we look at how we come out here? You would put a limit order out here to sell right now. A limit out at, let's say, 4.5 to sell. Then you would sell out of that, and as long as this side of the market keeps bouncing, you still net long with your limit orders out here on a $600 call. What are your limit orders out here?
1990 and 2190.
All right, so you got a limit order price objective on an exit. Over here, overnight, you bought a little bit of insurance, and that insurance cost a little bit of your two contracts and the profits you're up here, but it's still worth having that little bit of insurance debit to try to protect the two contracts should it be doing the opposite and gapping down like it did last week in pre-market $10, right?
Right. With
the Europe contagion and all of that, right?
Right.
So your entries are about what? What price are they?
On the 600 call, it's 950.
All right.
And on the 605 put, it's 570.
All right. So you were 20 cents above 9.30. We call that an excellent entry, and then the breakout happens. And once again, the breakout on the Google trade is doing what it's doing here in pre-market, 5:56 a.m., 11/8/2011. And it's live here with MMT. And so he has an exit and he has an exit. And depending on if they drop this down and it hits support, then he knows to exit the 605 put. So once again, the percent movement being 20 pennies above the close of the other day, and the high is 1610. He's in fairly decent shape as far as his two contracts with the breakout, the weekly breakout with Google that powered it to that price, and then exiting the 605 put. Yeah, so you make a couple $1,000 over here. Let's say you, on this side of the market against your $2,000 market, positive debit in here is that, hey, you mark down 150 So what? That still equals your net profit. That's the feature. We're going to be looking to see if Google can break above that 615 handle today.